Hey everyone, it's Mark Ferguson with Invest for More, and welcome to another real estate video. Today, we're going to talk about interest rates and housing. A lot of people are talking about this right now and how rates might cause a future housing crash. So I looked through a ton of data, did a lot of research for this video, and there was so much data that surprised me. Like I was not expecting it. So it'll be really fun to go through this data, show you the charts, the numbers, and the history of interest rates and the housing market. So we'll have tons of information on that. But of course, check out investformore.com for articles, other videos, all kinds of information on real estate investing. I'm gonna have a brand new article about this same topic too. It will be on there if you prefer to read things and look at the data yourself. And we'll show you that article on here as well. Of course, we like it when you like our videos too and comment. I love seeing the comments and what you guys think. So keep those coming too. But let's get right into it. So I wanted to make this video because I keep seeing over and over again, when interest rates go up, the housing market's going to crash. It has to. That's what happens. Interest rates go up, housing goes down. Now, I talk a lot about the housing market and what I think will happen. I've made a number of videos about the housing crash, affordability, all types of things regarding the United States housing market. And my opinion is, I don't think it will crash. Now, I may be wrong. We could I'll come back to this in 2 years and say, Mark, what the heck were you thinking? But, none of us have a crystal ball. We can't guarantee what we think will happen, but we can give our best guess. And the reason I say I don't think the market will crash is because, yes, prices are high, but they're not that high compared to history. If you look at the graphs of how housing has gone over the years, we had a really big steep climb in early 2000s, a dip, now another steep climb. But if you average it out, it's not like crazy high. Now, there's also been other countries, Canada, New Zealand, Australia, many European countries that have had sustained crazy housing markets for 20, 30 years with no real crash. So housing prices in themselves don't mean the market will crash, right? People say, well, what goes up must come down. Not really. I mean, over time, because of inflation and the decreasing value of money, everything costs more over the years. That's just how it works. Prices just keep going up over and over and over again. Now they can fluctuate and go up and down, but over the long run, prices do always just go up thanks to inflation. So the thing that really comes into play with interest rates and the housing bubble that people call it, or housing crash that might be coming, is that the higher interest rates are, the less house you can buy, right? The more your mortgage payments are, the less house people can afford. So people have made the assumption that because interest rates are really, really low right now, incredibly low, and that's some of the crazy numbers we'll show you here, that if they go up, less people can afford to buy houses, and that automatically means housing's done. But there's so many other factors that go into it. We talked about affordability, or we talked about housing prices themselves, but affordability. The United States is one of the most affordable countries to buy a house in the world. Just wages compared to what houses cost, it's still one of the cheapest places to buy anywhere. And there's also not enough houses. Some estimates say we need 5 million more houses to meet demand. And they build about 1 to 1.5 million a year. So it's going to take a very long time. And I talk about that in my other videos. There was not enough houses built for years and years and years. And that's why we have this inventory crunch that we're in right now. So what does the data show about interest rates and housing prices? We'll show you that. But first, I want to show you exactly how much interest rates can impact the housing mortgage payment, so you can see why people think interest rates will be so detrimental to the housing market. Okay, so here's the article on my site that will be published soon. You'll be able to read it when this video is out. And the one thing I really want to talk about right here is how interest rates affect the affordability of a home. And a lot of people don't understand how amazing the environment we are in is right now because interest rates are so low, and how much money they're saving, and how much of an impact low interest rates make on a house or car or whatever it is they're buying. So if we were to take a $300,000 mortgage, a 30-year loan, and have a 3% interest rate, which is possible right now for a house you live in, your payment would be $1,264 a month. The principal you pay down would be $514 a month. That's how much you pay off the loan each month. And the interest would be $750. Now, what's crazy is people take this for granted right now. Like, oh yeah, buy a $300,000 house, my payment's $1,200. Now you'll have taxes and insurance and other costs there, but the loan part of it is $1,200 a month. That is insane. That is so amazing. Because if you look at the past, right, if rates go up 1% to 4%, your payment would be $1,432. But what's really interesting is your principal would be $432 paid off each month. So even though your payment is going up, the amount you pay off every month goes down because the amount of interest you're paying goes up so much. And so the higher the interest rate is, the more interest you're paying in the beginning of the loan, and well, the whole loan, but the less you're paying down your loan as well. So let's say the rates go up to 6%, which would be crazy. I do not think this would happen. It's another thing to consider is even if rates do go up this high, we'll talk about if it would hurt the real estate market or not, but it would be so, I think, unlikely to have them go as high. But just in case they do, if rates were 6%, your payment would be about $1,800 a month. And look at this, your principal goes down to just under $300 a month, interest $1,500 a month. So we go back up to here and compare this. You're paying off $216 less every month, even though your payment is $534 more a month. So this is why interest rates have such a huge impact on your payment and are so amazing right now. So this gives us an idea of why people think, oh, if interest rates go up, fewer people will be able to buy homes, homes will be more expensive, they have to go down in price. But we're going to look at the history here and see if that is really true or not. I'm still here. Do interest rates historically impact housing prices? Here's some really cool charts I got from the Fred, St. Louis Bank. Amazing stuff they have there. If you ever want charts, check that out. But I think we can click these and they get bigger. Look at that and prettier. So this is the bank prime rate over history that shows what the rate has done. And you can see it goes up and down pretty, often. In the late 70s, early 80s, it went crazy, over 20%. And it's been dropping really low, went up a little bit, dropping. So that's an interesting chart. All right, so another interesting chart right here. This is the median sales prices of homes. So you can see it's very pretty right here. Really pretty steady. Had a little dip here in the 90s, a little dip here, bigger dip here, been going up and up and up. But I was talking about the affordability before, so if you really take, a ruler and run it along here, yes, prices have been going up more recently, but it's not like they're just shooting straight up like this compared to historic prices. Yeah, they're higher, but they're not crazy high. So it's not something I'm super worried about. Now here you can kind of see these two charts together, which is more important. And what you want to look is like, historically, do rates greatly impact housing? And this is a prime rate versus median sales price. And you see this, look at these rates going up. Housing prices. Well, we had a tiny dip here and a tiny dip there. And that's when rates were over 20%. We had a dip here in the late 90s, but rates went up a little bit before that. But if you look at the chart, they started going down before that dip happened. And rates started to go up here before the crash. Maybe those rates caused a crash, or maybe it's because of the horrible lending and absolute crazy building and all the other stuff. So there's not a whole lot of correlation here. Like if interest rates caused houses to crash, this should have caused like the biggest crash in the history of the world, and it didn't. It didn't hardly even cause a drop, just barely one. So we'll still keep looking. You know what else we have that's pretty interesting? These are actual mortgage rates. So before, we were looking at the bank prime rate. But it's also important to realize that just because the Fed prime rate, the Fed rates go down, that doesn't mean mortgage rates will follow them to a T. If you look at this chart, it's much less volatile. And you don't have those big giant ups and downs. You had this mountain here that's slowly been decreasing. But in the early 2000s when we saw those rate hikes, it didn't really translate to mortgage rates. A tad. They touched up a tad, but not that much, and they've been going down. So maybe it wasn't mortgage rates that caused that big crash right here. You see that dip there, or that big bump? Not here. So that's something else to consider. There's a lot of things to look at when looking at rates. Now, I know it took me a while to get to this. This is a cool chart my nephew made. It compares the two. mortgage rates versus the median housing prices in the United States. And so you can look at this chart and please tell me where the correlation is that shows really high mortgage rates cause housing prices to drop. Maybe a little bit right here. Like I said, a little bit, but we're talking about 2 or 3% drop right here. This is about a 5% drop right here. This is about a 30% drop right here. You just don't see it. You see these rates jump up here. I mean, that's a pretty big jump in rates. No decrease. Another pretty big jump in rates right here. No decrease. A huge, massive jump in rates. Very small, minimal decrease. Along here, we keep seeing rates drop and drop and drop. And what you might see is that a drop in rates could cause prices to go up. We have a pretty good drop right here. Did that help cause the housing boom? Possibly. Then we saw, another drop as the economy tanked. The Fed just kept dropping it, and that could have helped cause prices to go up. So there might be some correlation between prices going up and interest rates going down. But is there any historic evidence of high interest rates causing a crash? I have not been able to find any. Now, that's me talking. And one thing before we get into the studies, because I'm not just going to talk about it myself. There are multiple studies that have talked about this as well. For fun, what would your payment be on a $300,000 house at 18% interest? Back here, $4,500 would be your payment if the interest rate was 18,000 or 18%. You remember up here? It was $1,200. Now it's $4,500. And guess what? $4,500 is interest. $21 goes to principal. That's how crazy it was back then. And you know what's really crazy? If you paid that house, that rate for 30 years, you would have paid $1,327,000 and $652 in interest over that loan. Do you know how much interest you would pay if the interest rate is 3%? $155,000. So it is so crazy to compare now to the early 80s and how much better it is to use loans and debt. But even with these astronomically crazy numbers and ridiculousness, the housing market did not crash. It barely had a blip. It just kept moving along steady. So to me, that is pretty clear that interest rates do not cause the housing market to crash. But I'm not the only one you probably want to hear from. I have another study, a recent study that goes over, here we go, interest rates and house prices in the United States and around the world. Was done in October 2017, so before coronavirus and all that, but after the last housing crash. This is a very long technical study that goes over tons of information and data that I understand a little bit of. So we won't go into all of that. But I have some quotes from that study that I wanted to bring out to give you an idea of what it said. The study does say that they found some correlation between interest rates and prices. But for the most part, they were talking about lower rates causing higher prices, like we were talking about too. They had very little, unless I missed it. If you guys want to read through that study, I'll link to it, and it's linked to here into my article, and tell me I'm wrong, please do. But it's hard to find any data where they showed high rates caused low prices. They found data where low rates caused higher prices. And they also say that the changes tended to lag, right? It wasn't like they changed interest rates and right away housing prices changed. It lagged up to 2 years to see these differences. And they also mention here, there are many cases where real house prices simply kept on rising regardless of interest rate changes. Australia, Austria, Canada, Hong Kong, Malaysia, Norway, Peru, Sweden, Switzerland, for the past 10 years or so, had rate changes up and down. Their prices just kept going up pretty much. Didn't matter what rates were. Now here's something interesting too. Other studies have been done before this study, and they admit in this study most empirical studies assume short-term interest rates do not influence house price growth other than through domestic cost of borrowing by their influence on long-term interest rates. This is really important right here. This study that did say rates impact, the housing market, They're talking about short-term interest rates like the prime rate we were showing you. They were studying the prime rate that's much more volatile, not the mortgage rates. They're saying that the other study said short-term interest rates don't have much of an impact. But this study is saying they think those studies weren't done right. Short-term rates do have an impact. So there's no clear, yes, rates impact housing prices. The studies disagree. And even the study that does say rates can impact housing prices, if you read it, it's a matter of 5%, 4%, 3% changes in prices, not 20, 30, 50% that people are predicting for this massive housing crash. It's very, very small, and they're saying it can take years to actually show up in the statistics as well, because there's a serious lag in housing sales and purchases based on interest rates, because housing is hard to sell and expensive to sell. So it doesn't just immediately change. But based on these studies, the low rates show they can increase sales, but the high rates don't really show as much that they can decrease sales. They tell us it takes a really long time for it to impact sales and prices. And there's some studies that show it doesn't really affect it at all. So after looking at this data, after looking at the studies, even though logically you look at these numbers and say, oh my God, of course interest rates will impact housing because it's so much more expensive, the data does not show it. The data shows that even astronomically high interest rates, 18% interest rates here, did not cause a significant drop in housing. While maybe low rates have caused our larger increases, that doesn't mean high rates will cause a decrease. There's so many other factors that will be variables in this. Housing, cost to build a house, housing supply, they aren't building enough. Affordability, which really isn't as bad as many people say it is. Yes, interest rates can play some role, but probably not a massively significant one, as we can see in supply and demand, population changes. There's so many different things. The economy that will affect housing prices, that just a change in interest rates is not the end of the world. Now, I think anybody who can should be taking advantage of rates right now with as low as they are. It is such an amazing time to get a loan. Like, you're literally almost getting free money because interest rates are lower than inflation, which is crazy. But that doesn't mean that if rates go up, we're all doomed and the housing market is done. All right, I know there's a lot of data and words and charts that we just talked about in this video, but hopefully it made sense. Basically, the historic data shows that interest rates do not have a great impact on housing prices. The studies show they do not have a great impact either. Some studies show there is an impact, but really what they're talking about is less than a 5% gain in housing prices up or down. And that's with lots of their fancy, crazy equations that are much more complicated than I could understand. And some studies say there isn't that much impact of interest rates on the housing market. So just because you hear that interest rates are going up, that means the housing market will crash. That doesn't mean it's true, right? You can't just use what you... So just because you hear that housing prices are going to crash because interest rates go up, doesn't mean that will happen, right? It kind of makes sense, like logically, you think, oh yeah, that makes sense. But there's a lot of things in the world that logically, make sense, but don't happen in real life, right? We are not in the perfect world situation. Real life is much different from theory and from what we think will happen. We have to look at history and the numbers. And the fact is, people want to buy houses. People want to have a place to live. And interest rates can impact how much house they can afford, but it might not really affect housing prices that much. There's so many other factors that will play into it. And boy, just supply and demand right now is so off kilter. There's not enough houses for people out there. And that is why prices keep increasing. Building costs keep increasing, land costs keep increasing, utility costs keep increasing, permit costs keep increasing. So the cost to build a house, it just keeps going up and up and up and up. And they aren't even building enough of those. So until they build more houses or are able to decrease the cost to build houses, I don't see our market slowing down. Now, I could be wrong. There could be something crazy that happens and everything explodes. But remember, there are only 4 crashes in the history of the United States. The last one in 2008, which was the worst, the Great Depression, like 1879, like 1837. Those are the only housing crashes in the history of the U.S. defined by more than 20% drop in pricing. So this is not something that happens all the time. It doesn't happen every 18 years or every 10 years. It happens pretty much twice a century, maybe even once every 75 years is how often a housing crash happens. So don't expect them to keep happening over and over and over again. All right, thanks for watching. Hope this was helpful. Hopefully I got all my numbers right and everything made sense to you. If not, comment below and tell me why I'm wrong. We love the likes, love the shares, and of course check out investformore.com for much more information on flips, rentals, being an agent, all that great stuff. And we have 9 books on Amazon too, so make sure you check those out if you really want to learn how to invest in real estate, flips, rentals, being an agent, all of that great stuff, which is what we do too.